Hey everybody, this is John. You probably just finished the chapter in Mastering the Trade on the internals, and I just want to do a video here that shows kind of some live market action. This is actually from April 4th, 2012. We've actually got a pretty decent sell-off today in the S&Ps, and just want to take a look at kind of live market data, kind of give you an idea of what's going on here. So this morning was interesting because we actually got a gap down of about 12 points, and then we gapped down, and you can see here that ticks came down to about minus 700 or so, and then they stabilized for a little bit, and during this time the S&Ps traded sideways, and then we just got whacked here. And you can see the downtrending moving averages here, and you just came down and you made essentially lower lows, and then each high tick was actually a little bit lower as well. And sometimes you can actually even draw trend lines on the ticks like that. I just used the moving average there because you can see the moving average is sloping down, but you can see there the ticks just they just couldn't get through that. So you had consistent selling pressure. You had a couple little pops here, but they just couldn't do much. And you can see we're just getting the repeatedly minus 1,000, minus 1,000, minus 1,000, minus 1,000. So remember, one of the things I talk about too, if you do spend, the first part of the morning, especially mostly below zero, then you want to be careful about trying to buy these. You actually, on a day like this when the ticks are so consistently low, anytime you get a pop up, you actually use that as a fading opportunity. Okay, and it may not get to plus 1,000, but that's also one thing I didn't really talk about in the book is you can actually put just like a 5-period RSI on your chart. And when you do get overbought, that actually is the same as kind of a tick fade, because what's going to happen is there's going to be some days when you don't get the nice kind of, oh, here's a plus 1,000 reading, here's a minus 1,000 reading. You're getting a lot of selling, and you're not going to get any opportunities to short plus 1,000 tick readings. They're not going to get there. So on days like that, you can look for overbought RSIs and use those as signals to do the tick fades. All right. And if we come here and look at the markets now today, and you can see here this morning we had kind of that quiet action this morning, and then when the extreme ticks hit, bam, we just sold. And this was actually on the overnight session here, and you can see like when the ticks came down, you just got some massive selling here. So it is helpful just to kind of give you an idea, because right now, of course, as of April 2012, I mean, the markets have been going up, and up, and so it's very common to say, hey, gosh, we should buy these pullbacks. But you really want to sit there and look at the ticks and give you an idea of like, okay, is it safe to buy the pullbacks yet? Now, I like the fact right here that the moving averages are popping up back up above zero. You can see we've got a blue TTM here, so that's good as well. Okay, and you can see we had a 5-minute squeeze. It fired off short, and that momentum is done, and so that's good as well too. Okay, so it's showing here that there's a decent area to at least take a long, okay, and put a stop at the lows, or if anything, look for it's going to start of a rally that could take us back up to resistance, and that would be an area to short. Okay. So the other internals that are going on here, so the put-call ratio. The put-call ratio is over 1. Okay, so when it gets over 1 like this, you do want to start getting a little bit cautious on the short side. For example, right here, I'm not too excited about shorting right here, even though the market's down 16.5 S&P points, because the put call is pretty high. That means a lot of people are panicking here. They're adding puts, they're adding shorts. And when you get too many people on the one side of the market, it generally puts in a floor. So I'd actually look for the market here to kind of stop going down and start going up until this put-call ratio levels itself out, until some of this panic starts to work itself out of the market. Vol spread, of course, just been heading straight down. You can see it's just consistent selling. So this is a true downtrend. And so, by the way, on something like this, when you're looking to see if the market can bottom out here a little bit, you're just looking for a little bit of a scalp trade. You're not looking for, quote unquote, the bottom of the day. If we're going to actually see a bottom, we'd actually, like where the market would actually go positive today, we'd actually start needing to see consistent plus 1,000 tick readings, which of course at this point we're not getting. We might later, but at this point it's cautious. It's really more of an indication at this point you don't want to short. This is not a good place to short. You could try to scalp a little bit up here to the long side. VIX here has popped up a little bit. You can see it's easing back, and as long as this is easing back too, you would look for ticks to pop higher. And then finally, Aussie yen. This is one I talked about in the book as well. Aussie yen cross here. It sold off pretty hard in the overnight session. What happened is yesterday the FOMC minutes came out. They said they're not going to do any more quantitative easing, which may or may not be true, but either way, the markets around the world reacted. The dollar exploded higher, and now you can see all this action that's going on here. Well, remember, Aussie yen, if it's going lower, you're going to see stocks go lower, and if Aussie yen is going higher, you'll see stocks go higher. And you can see Aussie yen here is firming. All right, so it's firming nicely. So guess what? Stocks are firming nicely as well. Okay. The other thing I like to watch too on days like this, of course, the sector sorter list. So these are the main ETFs here. I've switched a little bit from the book. You can actually look at those sectors that I listed, or just look at the ETFs. These are the top holdings. So here is like XLY right here, and so then XLY is consumer discretionary. Then you can, below that I'll have, okay, so McDonald's is the biggest stock in the consumer discretionary sector, and I can see that it's down 1.43%. Amazon is the second biggest, and it's down 2.91%. And you can see of all the sectors, they're essentially all down today except consumer staples. So consumer staples is up today essentially because you got a couple of the big stocks here, Procter & Gamble up, and that's helping it a little bit there. But I also like to look for anything that's standing out. So you've got a sea of red today. Is anything standing out, on the green side? Well, AZO, AutoZone is standing out. Like I said, consumer staples, XLP is standing out. You got a stock here, LQDT, which is a liquidator stock, which is doing fine. But the big names are getting hammered today. Even Apple's down today. If you look at the futures contracts, you've got the S&Ps, Nasdaq, Russell, all down over 1% today. Bonds are up, so you got kind of a flight to safety going on. Dollar index is up 42 ticks. All the currencies are down except the Japanese yen. A little bit of a flight to safety there. Aussie yen down, of course. And you can see gold's getting hammered, down 51. Silver getting hammered even more, down 5%. So essentially this is a kind of one of those days where there might be a shift in overall sentiment. It's more of a flight to quality. Dollar's going higher, everything else is going lower, and we just don't want to fight that. And a couple of other things here that I like to look at. This is the daily put-call ratio on a daily chart. I've plotted a 10-day moving average on here, so I can kind of see where we are. You can see that, essentially if it gets too high, you're looking for an important market bottom. Same thing too, if it starts coming too low, you look for an important market top. So you can see right now that the put-call ratio, so putting today's sell-off in perspective, we're not showing extreme bullishness here. Now we did show some extreme bullishness right here, and you can see that the market did sell off for a little bit here, but then just kind of kept on going. So when I see something like this, I'll go, okay, well, the market's coming down, but today's sell-off, may just be a couple of days, and then we resume the uptrend. If you do get a situation like this, and you start to see a sell-off, it's like, wow, this could be a serious sell-off because there are so many people that are long here. And then I just kind of want to put this up here. This shows a couple of days of activity going on in the ticks. And you can see right now, of course, we've spent, the ticks tell you a lot, just kind of where they've hung out. You can see like today we've spent an inordinate amount of time below zero. I mean, a lot of time below zero. And on a day like that, you just don't want to fight it. Okay, you don't want to focus too much on buying dips. What you want to do is say, all right, if you pop up here, that's a good area to short. Like when I showed you on those overbought or oversold RSI readings. And then you can see here on a day like this, where we got this nice uptrend. Okay, again, you don't want to fight it if the ticks continually are hitting plus 1,000, plus 1,000, plus 1,000, plus 1,000. When they're pulling back, they're only pulling back to like zero. Okay, on a day like that, you don't want to fade the ticks. You want to go with the ticks. Okay, meaning that if they pop up here and then they pull back to zero, that's your opportunity to buy and join the current uptrend. Okay, so the ticks do tell you a lot about the markets. Unfortunately, they are only available on the stock market. Somebody asked me once, hey, are there ticks on the euro or crude oil? And there's not. It is just something that is unique to just the U.S. stock market. So for example, looking at this today, the only way I would see, or the only way that this market could actually have a significant rally today would be that the ticks go from hanging out below zero here to actually something like this. That's the only way that a rally could happen. Otherwise, we're just going to be this is just kind of a chop. Kind of a kickback rally, and then you'd expect that the ticks would resume again down here and we'd roll over. Okay, so the only thing here that could change this tide is that a bunch of consistent and steady buy programs come in and hit this market. Okay, and finally too, now even though the tick here actually covers the NYSE stocks, which essentially is more, it's more closely resembles the S&P. You can actually use it for the Nasdaq as well. Now there is the Nasdaq tick as well. But the question then is, you don't want to have too many things on your computer. You don't want to have one tick for the S&P, one tick for the Nasdaq, one tick for the Russell, et cetera, et cetera. You can if you want, but you don't really need to. I mean, guess what? If this is going, if this goes higher, then guess what? The Nasdaq will pop up as well. So you can just use one, and if you are going to use one, then I would use this one, the tick that's on the NYSE, because that does reflect essentially the broadest market. Okay, so hopefully that helps. As always, if you guys have any questions, just let me know, and see you at the next video.